Introduction. Hello and welcome to this video on accounting conventions. In this video, we will discuss the different accounting conventions used in financial reporting. Body. Accounting conventions are the basic guidelines followed by accountants to ensure consistency and accuracy in financial reporting. Here are the three most commonly used accounting conventions. 1. Consistency convention. The consistency convention in accounting requires that a company use the same accounting methods and procedures from year to year. 1. This convention ensures that financial statements can be easily compared from year to year and that changes in financial performance can be attributed to actual changes in the business rather than changes in accounting methods. The consistency convention means that a company cannot change its accounting methods or procedures from one year to the next without a valid reason. If a company decides to change its accounting methods or procedures, it must disclose the change in the financial statements and explain the reason for the change. For example, if a company has been using the straight-line method of depreciation for its fixed assets for several years and then decides to switch to the declining balance method, it must explain the reason for the change and the impact of the change on the financial statements. By following the consistency convention, companies can ensure that their financial statements are comparable over time, which makes it easier for users to analyze and understand the financial performance of the business. Conservatism convention. The conservatism convention is one of the most important accounting conventions. It requires that accountants be cautious when recording financial transactions, which means that they should not overestimate assets or revenues and should instead err on the side of caution by underestimating them. The main purpose of this convention is to prevent companies from overvaluing their financial position and to provide a more realistic picture of their financial situation. Under this convention, accountants are required to record all potential losses or expenses, but they should not record potential gains until they are realized. For example, if a company has a pending lawsuit, it should record the potential loss in its financial statements, even if the outcome is uncertain. Similarly, if a company has a slow-moving inventory, it should record a potential loss due to obsolescence or market price decline. The conservatism convention also requires accountants to choose the method that results in the least favorable financial outcome when there are multiple methods available. For example, if there are two methods of valuing inventory, one that results in a higher valuation and one that results in a lower valuation, the accountant should choose the lower valuation. In summary, the conservatism convention requires that accountants take a cautious approach when recording financial transactions. This helps to ensure that financial statements are reliable, accurate, and not overvalued. Matching convention. The matching convention is an accounting convention that requires a company to recognize expenses in the same period as the revenues they help generate. This means that when a company generates revenue, it must record all the expenses associated with generating that revenue in the same period. This is based on the principle that expenses should be matched to the revenue they help generate in order to accurately reflect a company's financial performance for a given period. For example, if a company sells a product in January but incurs expenses related to producing and delivering that product in February, the matching convention requires the company to recognize those expenses in January, the same period in which the revenue was generated. This ensures that the financial statements accurately reflect the expenses related to generating that revenue. Overall, the matching convention is an important principle in financial accounting that helps ensure that a company's financial statements provide a true and fair view of its financial performance over a given period. Conclusion. In conclusion, accounting conventions are an essential part of financial reporting. They ensure consistency and accuracy in financial statements and provide users with a clear understanding of the company's financial position. The three most commonly used accounting conventions are consistency, conservatism, and matching. By following these conventions, companies can ensure that their financial statements are reliable and useful for decision-making purposes.